Cryptocurrency trading is a great way to earn money, and there are many methods of trading to try. However, new investors should be wary of the potential pitfalls associated with new ventures. The cryptocurrency market is extremely volatile, meaning that it can change very quickly. That means that any strategy could become obsolete overnight. Because of this, investors should only risk what they can afford to lose in case of an adverse change in the market conditions. You probably know all about Bitcoin, Ethereum, and other popular cryptocurrencies. But have you found out the most important things that you should never forget? If not, then this video can help you watch till the end. Hey everyone, this is Sama TV, where knowledge is power. Like and subscribe help us grow this channel. If you're new to cryptocurrency trading, these are the 7 rules you must follow. These 7 rules will help to increase your profits and minimize potential losses. 1. Don't take very big bets. The phenomenal returns given by some cryptos in the past 1 year are mouth-watering. $130 invested in Dogecoin 6 months ago is now worth $7,450. But don't get carried away by these numbers. Invest only what you are willing to lose. Even if you have a high-risk appetite, start trading with small amounts. Don't put more than 2% of your overall portfolio in cryptos. After you get familiar with the arena, read up about various coins and understand their value and prospects before you allocate more. 2. Be ready for extreme volatility. Investing in cryptocurrencies is the best way to learn about them. But it is a high-risk, high-reward game, and you must be able to digest very high volatility. As the May crash showed, an overnight fall of 70-80% is also a possibility. Keep in mind that even a blue chip like Bitcoin is down 48% from its April high of $70,000. Enter this market only if you can stomach extreme variations and the implications of an investment going wrong. 3. Use trustworthy platform. The crypto space is not regulated in many countries and new outfits are mushrooming every day. Though the court has struck down the ban on cryptos and the government has hinted that it will follow a calibrated approach towards regulating the industry, investors need to be careful when choosing the intermediary. Invest through an established and trustworthy platform so that your money does not get stuck if there is a regulatory setback or the promoter company goes under. Keep in mind that investing through an overseas platform may require greater compliance on the tax front. 4. Don't act on tips without verifying. The crypto space suffers from a severe lack of credible information. Investors are dependent largely on unverified information on social media. Self-styled crypto analysts create WhatsApp groups packed with their accomplices who vouch for their accuracy. These analysts trap gullible investors, first by charging a fee for the tips and then using them for their pump and dump operations. As a rule, you should verify the information before you invest. Check the market cap and trading volumes of the coin. A low market cap and insignificant daily volumes are obvious red flags. 5. Focus on blue chips. Like the stock markets, the crypto market also has blue chips, mint caps, and penny coins. Don't get tempted into buying obscure coins just because you can get a lot of them at a low price. Bigger coins may be costlier but are more stable. In any case, you can buy in fractions, so don't worry about the price. Bitcoin is the blue chip of the crypto space and drives the overall market sentiment. Focus on the blue chip coins like Bitcoin and Ethereum. 6. Keep abreast with global developments. Even though you may be buying and selling in India, the crypto market is spread across the world. Any global development can impact prices, so one needs to be abreast with what is happening in key markets like the US, Singapore, and Europe. The crypto tax in the US was one of the reasons for crypto prices falling in May. An alert investor will not get caught on the wrong foot. It helps that crypto trading is 24/7, so one can act immediately, unlike stock markets where one has to wait for trading to open the next day. 7. Don't ignore the tax. Last but not the least, don't ignore the tax payable on the income from crypto trading. Even though cryptocurrencies are not specifically mentioned in the Income Tax Act, income in any form from any source is taxable unless specifically exempted under the Act. Cryptos are not considered currency by the respective governments, so they must be treated as capital assets. There is no judicial precedent, but it can be as capital assets. This means short-term gains will be added to income and taxed at normal rates, while long-term gains will be taxed at 20% after indexation. A lot depends on the volumes and frequency of trading, which may lead to the income being treated as business income. Follow these 7 rules for successful investing. Hope this video helps you. Comment down below, what do you want me to cover next? Like and subscribe if you haven't already. The Samu TV signing out.